Hello, ladies and gentlemen. Welcome to Health Life 360. I am Dr. NIK NIKAM. Along with my partner Sudhir Mathuria, we would like to talk to you about life insurances to finance business buy-sell agreements. What is business buy-sell agreement? Why should we use life insurance as a means of buying out the other partner's interest in the business and all the ramifications related to that? So let us begin with the feature presentation. First of all, as I said, we represent the Health Life 360, and here are our contact information. So you can contact us anytime if you have any questions and you would like to know more about not only buy-sell insurance agreements, but also a number of items related to health insurance, life insurance, and also Medicare Advantage plans along with annuities. So let's take a scenario where Jack Jr., age 45 years, is a 50% partner in a computer store business along with John Sr., who is 55 years old. This business has a total assets of $2 million. That means each partner, Jack and John, own $1 million worth of assets in this business. Now, just think of a scenario, an unfortunate scenario, which hopefully never happens to anyone. If John Sr. were to pass away due to a plane crash or an accident or some other illness, now how is Jack going to, one, continue the business, number two, pay John's family the $1 million, which was the John's share in the business, and how is he going to come up with $1 million? I mean, he can't go to Google and pull out $1 million note and pay it. You got to have some means of how you're going to finance that $1 million, because you want to keep the continuity of the business. You want to have peace of mind, and you want to make sure that all the requirements are met. So I'm going to walk you through how we can simplify this process. First of all, let us look at, just in case you had no business sell agreement and proper channels in place, what's going to happen? If John were to pass away unexpectedly, then Jack has to pay John's family $1 million. I'm talking $1 million. Not only are you grieving about the loss of your partner, now you're dealing with a $1 million money which you have to come up in a short order. Typically, in a business setup like this, a $1 million is paid over 10-year period at interest rates ranging from 7, 8, or 9%, and this is being paid from your pocket with after-tax dollars. So by the time you finish paying off your business partner's $1 million share in 10 years, you would have incurred a cost of $1.9 million after tax dollars. Can you imagine how much you had to increase your business without the help of your senior partner, who was the key person in the business to generate the revenue? This is an astronomical task. Not only are you dealing with the goodwill of the senior partner, you're also dealing with a substantial financial hit on your pocketbook, on your business, and how do we solve this? That's the key question which we're going to answer. Keep in mind, not only do we have to pay the partner $1 million, but for the next 10 years, since you owe money to the family of John Sr., you may be involved with board meetings with John's spouse, her attorney, and whoever else wants to get into the boardroom. So this is a scenario you really don't want to have. You want to avoid this at any cost. Since you and John are very good friends, know each other very well, the best time to address this issue is when you're alive and when you're healthy. So here's what we would suggest, in order to meet that financial obligation, continue the business without any interference from outside sources, including the deceased spouse or lawyer involved in your business dealings. So, how do we do that? Basically, we recommend Jack Jr. buy a $1 million policy, insurance policy, on John. And in case John were to pass away, that $1 million policy will pay $1 million to Jack Jr., which is tax free because his policy was bought with after tax dollars. And he will simply give that $1 million to John's family, and then he would take the entire business in his hands and proceed with rebuilding the business. Similarly, John Sr. would buy a $1 million policy against Jack Jr. And if Jack Jr. was to pass away because he likes this speedboats, scuba diving, whatever it is, now John Sr. can pay off Jack's young family $1 million from the insurance proceeds and try to rebuild the business from that point onward. It is simple, but it is not simple. It is a complex process because it involves many different points, people, and also a clear understanding of the business buy-sell agreement. So let us see how we're going to do that. In order to accomplish, first of all, we have to assess what is the appraised value of the business at the present time and what it might be in the future 10, 15 years down the line. So you have to come up with a composite number. Okay, the business is worth $2 million. The business is worth $2.5 million, whatever the amount is, as agreed upon both of you. Number two, you have to discuss with your tax consultant about tax consequences of exchange of money. Even when you buy life insurance, if you buy it from a corporation, and it will be taxable income. So you have to be aware of tax consequences. Number three, you have to involve a lawyer to draw up an agreement between two of you, and all parties involved, including your spouses, should be aware of this business agreement so that in case of the demise of one of the partners, this business agreement will be set in motion. The other party will get their $1 million without having to wait for 10 years. So the surviving partner can continue on with the business without any interference. Typically, a term insurance I'm talking about, for $1 million for 10 or 30-year fixed term insurance, the cost could be $1,200, $1,500, or even if it's $2,000. It's worth it, and I'll explain to you how. Then Jack Jr. says, hey, $3,000 per year for two people or $100,000 over 30 years, that's a waste of money. That's nonsense. These insurance agents, all they want to do is sell insurance. Hold it, Jack. That's not the issue. The issue is you're going to incur cost, and which is a better option. That's what I want to focus upon. Let's look at it. If you were to pay John's spouse $1 million over 10 years, remember it carries a 7 to 8 or 9% interest. Number two, you have to pay this money with your after-tax dollars. So by the time you pay off the money in 10 years, the total cost you will incur would be $1.9 million and not $1 million. And not to mention that you may be dealing with the spouses or her attorney in your boardroom because she's still a partner in your business until the loan is paid off. There's another option. You can get a whole life insurance which costs like 10 times more, but it has some added features, like it can have premium waiver in case of disability. There's a typo here. I fixed it. I don't know. It still has the same typo. disability. It can cover chronic care illness, and it can also cover terminal illness clause, have a terminal illness clause. So there are some benefits to having a whole life insurance, but if you don't want to go that route and spend 10 times more, you can just go with a simple term life insurance with fixed period and fixed payments, and that should do the job. Now let's look at it. Let's compare apples to apples. How much does it cost in terms of life insurance in case John were to pass away? How much does it cost Jack over 30 years if he were to get a term insurance at a rate of, say, let's $1,500 or $2,000 per year? That's $60,000 fixed. You know that $60,000 is going to guarantee $1 million coverage that can be used to pay off the deceased spouse. All right. But on the other hand, as I said, if you didn't have any insurance, if you didn't have a buy-sell agreement, then if you went through the traditional route where you have to pay that $1 million share over 10 years with interest and with after-tax dollars, you are incurring more than $900 extra over 10 years. So now you decide, is $60,000 too much or $900,000 over 10 years too much? The answer should be simple. You know, the best time to do that is when you are real friends, you're healthy, and the business is doing good. You get together, and because you heard this presentation, you heard it from us, how to be proactive. You sit down with your accountant, the appraisal people, and lawyers, and draw up this business buy-sell agreement. Consult with your accountant about tax consequences. And then, you don't have to be dealing with lawyers in a litigation. You don't have to be dealing with the deceased spouse or her lawyer in your boardrooms when you're trying to scratch your head how to come up with $1 million to satisfy the requirement of paying off your deceased spouse. It's a sad situation. I don't think you want to be in that one. So let me tell you, you don't have to climb at the mountain and start screaming because now you're stuck in a rut. You don't have to be. All you need to do is call us. We'll sit down with you one-on-one and explain to you, walk you through the steps. We'll make sure we have the accounts evaluated by an accountant, the business appraised by an appraisal. You have the lawyers draw up the agreement, and we provide you the life insurance and, most importantly, a peace of mind. So why not pick up your phone and call us at Health Life 360 and let us help you have that peace of mind so you can continue your business and succeed. Thank you so much for watching this presentation, and we have a lot of videos on insurance and also Medicare Advantage plans, and please do watch them, and please do subscribe to our YouTube channel. We will see you next time.